Case in point 1-3, determine the impact on accounts. In this example, we will determine which accounts have been impacted by each transaction and by how much they have either increased or decreased. Transaction number 1. Nathaniel invests $35,000 to open Nathan's Donut Shop. Cash was invested in the business. Since none of the $35,000 is owed to anybody, Nathan can claim ownership of the entire amount. Therefore, the cash account and the Nathaniel H. Spencer capital account, which represents Nathaniel's share of the equity, are impacted. Step 2. As a result of the investment, the company has more cash than it did before. Nathaniel's ownership interest has also increased, as he is now the owner of more assets. Therefore, both accounts have increased. Step 3. Since $35,000 was invested by Nathaniel, both the cash account and the Nathaniel H. Spencer capital accounts have increased by $35,000. Cash is an asset, so we would see a $35,000 increase here, and Nathaniel H. Spencer capital account is a owner's equity account. So we would also see a $35,000 increase in the owner's equity account. Notice after completing this transaction, our total accounting equation still balances. Assets equal liabilities plus owner's equity.